Another is to raise productive children. If you have children or grandchildren and you want to help them with their education, their health, their welfare, their future, if you're able to do that better with an efficient investment strategy that takes into account everything we know about and can control and creates dry powder, cash, dollars of future wealth to help children or grandchildren. Advisory fees, why do they matter? Because they are an expenditure of cash. Will it buy something of value? The ultimate question with the Moneyball method is to make money for what? Hello, everyone, and welcome back to the Moneyball Method podcast. This is Mark Shupe, the author of the Moneyball Method, a Middle-Class Manifesto for Objective Investing. As you may recall, 3 weeks ago, the subject of my podcast was financial independence. What does that mean? To answer that question, we concluded that it is the whole life approach to your money and self-ownership. 2 weeks ago, the title of my podcast was Investment Performance, When Does That Make Sense? And my response was when dollars of future wealth are the new performance benchmark. Last week, the subject of the podcast was capital market assumptions. How do they work? And I concluded that by the information of prices and the law of identity for each asset class. What I'm trying to deal with here are fundamentals, are basics, are essentials. And I'm going to do the same thing today and answer the question, advisory fees, why do they matter? Now, it really depends on which side of the advisory fee equation you sit. If you are a registered investment advisor, that is your primary source of revenue. If you are a client, that is an expense. And if you are an autonomous investor, essentially you're paying yourself for the investment strategy decision and its implementation. And like before, I want to break this down into the essentials, the fundamentals. What really matters with regard to advisory fees? And I'm going to start by making a statement. If you're a registered advisor, your clients pay you for investment strategy recommendations for stocks, bonds, mutual funds, exchange-traded funds, real estate investment trusts, alternative investments, and money market funds. If you are a client, you are paying a fee for that advice, for that service, for those recommendations. I want to start with question number one. What is the difference between stocks and bonds? This may seem basic, essential, almost silly because it is so fundamental, but can you answer the question, what is the difference between stocks and bonds in one brief sentence or two sentences? Question number two, what are the top two features of a mutual fund or an exchange-traded fund? Again, another simple, basic question, but can you answer that in a very brief sentence or two? Those two questions become a little more challenging when I add to it, what is the difference between stocks and bonds, and how does that affect your recommendations if you're an advisor? Or how does that affect the recommendations you receive if you're a client? Regarding the second question, what are the top two features of a mutual fund or exchange-traded fund? That becomes a little more challenging when I add, and how does that affect your investment strategy recommendations? Or if you are a client, how does that affect the recommendations that you hear? So I'd like to start by addressing those two questions. What is the difference between stocks and bonds? Stocks are a claim on future earnings. Stocks represent future wealth. Stocks are a risk asset. Bonds, on the other hand, have guarantees. Bonds have a fixed rate of return with regard to the rate of interest, and that is your total return if you hold on to that bond until maturity. But how does that affect the investment strategy recommendation? Stocks are clearly the wealth-producing side of the investment strategy decision, and that implies risk. There is a trade-off between risk and reward. For the objective investor, using the Moneyball method, Bonds represent a hedge against stock market risk. And the best hedge against stock market risk is AAA rated government securities. I do not consider bonds to be a profit center, but they do preserve wealth for the event that we have extreme market conditions or we have changing circumstances. They can be used in the future. They represent dry powder. What are the top two features of a mutual fund? They are diversification and liquidity. Diversification helps you mitigate risk. Diversification helps with regard to maximizing returns for any given level of risk. In other words, to help create an efficient portfolio, one where we are being compensated for any level of risk that we might assume. The second feature of a mutual fund is liquidity. We want to be able to know with confidence that we can turn our assets into cash when we need to, because the cash flow strategy decision is an important aspect of the Moneyball method. Liquidity is important. Illiquid assets, meaning it takes time and might be expensive to turn it into cash, has a direct impact on our future risk and our future dollars of future wealth. But how does that affect your investment strategy recommendations? Well, clearly, we want to own assets that we have confidence that they will do what they are supposed to do. We want to have a track record of performance. And it's very difficult to have a track record of performance for asset classes that are illiquid. So it affects our investment strategy decision with regard to the implementation. We want to have the confidence that we'll have access to cash when we need it. Another aspect of the advisor and client relationship with respect to advisory fees is that clients pay for risk management advice. They pay for being informed about market trends. So I would ask another question. If you're an investment advisor, what are the top 4 investment risks that you pay the closest attention to? Or if you're a client, what are the top risks that you want to be aware of and how they are being managed? But that becomes a little more challenging when I add, what are the top 4 investment risks and how do they affect your recommendations? After all, clients pay for risk management advice. The next question under this category is, what are capital market assumptions? I don't know that very many advisors can really answer that question with confidence and accurately. And I'm not sure that very many investors, whether they are clients or whether they are do-it-yourself autonomous investors, can answer that question. What are capital market assumptions? We did discuss that in some detail last week. But how do they affect the strategy recommendation? Regarding the first question, what are the top 4 investment risks? I would answer that with what I believe are the ones that we know about and can control. First is market risk. We can control our exposure to market risk. Market risk is not something that we can predict. It's not something that we can control, but we can control our exposure to it. We can control how much risk we take. This gets back to the first question, the difference between stocks and bonds. How much exposure to risk assets like equities, whether it's US companies or international stocks or emerging markets, are we going to be exposed to? We can control that, but we can't control market risk in general. How does that affect strategy recommendations? Well, we need to be flexible with strategy. If we are overfunded, we want to take less risk. We want to avoid unnecessary sacrifice and risk exposure. If we are underfunded, we may need to take more risk, or we may need to change our spending and cash flow strategy, or maybe a little bit of both. What are capital market assumptions? As mentioned last week, capital market assumptions are the defining attributes for each asset class. The broad market asset classes are US stocks, international stocks, emerging market stocks, real estate investment trusts, high quality bonds, high yield bonds, money market funds, gold, other commodities. Each of those are distinct asset classes that are defined by their attributes. Quantitatively speaking, those attributes are their historical median return, the range of returns as measured by standard deviation, and the correlation coefficient, how they react to each other. Those three attributes in harmony define each asset class and give us the best indication as to how they will behave in the future, understanding that that is not guaranteed. How does that affect our strategy recommendations? Well, it has a great deal of bearing on the random simulations that we perform to try to understand how capital markets might behave given your particular circumstances and your situation. And this brings us to the second risk of the top four risks that we know about or can control, and that is sequence of return risk. The order or sequence in which the actual investment returns occur will have a greater impact on your success or failure than the asset allocation strategy itself, meaning number one, market risk exposure. Now, sequence of returns we cannot predict, we cannot control, but we can simulate all potential outcomes for any given investment strategy combined with your age and life expectancy and your cash flow expectations. The third of the four risks that we know about or can control is underperformance. Active money managers, strategists, economists, analysts, all of them try to anticipate and predict the future of market performance to try to beat the index, whether it's the S&P 500 or some other benchmark. However, beating the index carries with it some extra risk. I call that underperformance risk. And underperformance risk is one that we can easily eliminate and can control. How does that affect our investment strategy decision? It does with regard to owning passively managed index funds that eliminate underperformance risk. What does that have to do with advisory fees? 1% of underperformance is equivalent to a 1% fee. Much like tariffs are a tax on your income, depending on how much you spend and what you spend it on, underperformance is similar to a fee. It has virtually the same impact on your performance, your dollars of future wealth, your funding status, your ability to meet or exceed future cash flow expectations. The fourth risk that we know about and can control is overspending risk. The cash flow expectations that we model when making the investment strategy decision could have a severe impact on success or failure as an individual investor. So what I've done here is I've identified four risks that we know about and can control: overspending risk, underperformance risk, sequence of return risk, and market risk exposure. But at the same time, I have ignored every risk that nearly every analyst and strategist and economist is consumed with. These are called idiosyncratic risks. I discussed them in last week's podcast. We ignore those because they are built into the price of securities that are currently trading on the market, for which we have an interest in, which we probably own. If all of them are discounted by the market, if they are included in the price information of each individual security, we can easily manage that through diversification. Those are diversifiable risks, and that's why we ignore them. So getting back to the original question, advisory fees, why do they matter? They matter because they are an expense. They do affect your cash flow expectations. And because they are something we know about and can control, we model those like any other expense that you might incur before making the investment strategy decision. In fact, with regard to the Moneyball method, the cash flow strategy decision supersedes the investment strategy decision. In fact, we treat your risk capacity, which your ability to withstand market losses or changing circumstances, as a capital asset, as something that you not only can measure, but will become part of the investment strategy and cash flow decision. And when we treat risk capacity as a capital asset, just like The value of your 401k plan, your IRA account, your brokerage account, your bank deposits, your mutual funds. When we treat risk capacity as a capital asset, that changes everything. So when does the advisory fee matter? It matters when we can look at that as a way to increase your funding status, improve your outlook for dollars of future wealth. Instead of adding alpha by trying to beat the market, we want to add alpha by increasing dollars of future wealth. So if you have an advisory relationship, either side of the investment advisor dynamic, advisory fees become a profit center if it allows you to enjoy your current lifestyle, not having to sacrifice the things that are important to you right now. How does that normally happen under the traditional advice model? Through conservative capital market assumptions that force you to save too much that you don't really need to, or make investment strategy decisions that are too aggressive. Another way that advisory fees can benefit you is if they allow you to retire earlier. If the investment strategy advice creates dollars of future wealth to allow you to retire earlier than you originally expected or planned, if that is important to you, that would certainly be a benefit to having that kind of a relationship. Another is to raise productive children. If you have children or grandchildren, you want to help them with their education, their health, their welfare, their future. If you're able to do that better with an efficient investment strategy that takes into account everything we know about and can control and creates dry powder, cash, dollars of future wealth to help children or grandchildren, that is a profit center. Or perhaps leaving a legacy for family or for charity. If you're able to do that, if that's important to you, that is adding alpha. That is adding dollars of future wealth. Or maybe increase travel now or in retirement if that's important to you. Again, it's up to you to decide what are the goals and aspirations that you're trying to fund. What is the most efficient way to achieve that? How does your cash flow expectations integrate with your investment strategy decision to be able to do these things, such as affording long-term care? One of the great benefits of Western civilization is people are living longer. One of the great challenges is there are health issues related to that. So do you self-fund if there's a history of Alzheimer's or dementia in your family that you might need long-term care? Do you buy insurance to help cover the cost of that if and when it is needed? Which one is preferable? How does that work with helping grandchildren or children or leaving a legacy or traveling more or retiring earlier? If your advisor can help you answer these questions, there's a lot of value to that. Or perhaps changing your careers. Maybe you would like to start a business. Maybe you are not happy in the current career path in which you were engaged. That might involve a capital investment of some kind. That might involve a decrease in disposable income. All of these things are things that we can model under different what-if scenarios, but only if we know exactly what our cash flow expectations might be and what the investment strategy is that will help you achieve that while avoiding unnecessary sacrifice and risk. And all of this is about having the confidence and comfort of living the one life you have, changing the performance benchmark to dollars of future wealth, changing your considerations of risk to the things we know about and can control that I mentioned earlier. Advisory fees, why do they matter? Because they are an expenditure of cash. Will it buy something of value? The ultimate question with the Moneyball method is to make money for what? Sometimes we have to spend money to make money. When do advisory fees matter? When they can help you live the one life you have in confidence and comfort. Thank you for joining me today. I hope that helps you answer those 4 questions. Financial independence, what does that mean? Capital markets, how do they work? Investment performance, when does it make sense? And advisory fees, why do they matter? I will see you next week.